Welcome to Mad Money. Welcome to Cramer. Hope you make friends. Hey, I'm just trying to make a little money. My job is not just to entertain, but to, well, put it all in context. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. We keep hearing that all the AI spending by the hyperscalers, the nation-state companies like Google or Microsoft, has to stop eventually. It's not worth the price. They'll regret it. They aren't getting a lot out of it. And then you get a quarter like the one Alphabet reported yesterday, where they added $10 billion to their already $75 billion capital expenditure budget. And you realize just how off-base these criticisms might be. As long as the spending continues to make sense, and that makes, well, it sure seemed made sense when in the case of Alphabet, which is the parent of Google, it seems like these investments are both urgent and needed. That spending is also a big part of the reason why this market can hang in there. Dow declining 316 points, but the S&P advancing 0.07%, and Nasdaq gained 0.18%. Last night, I listened to Sundar Pichai. He's the visionary CEO of Alphabet, talk about AI and how much it means to his company. I'll just give you one quote here. AI is positively impacting every part of the business, driving strong momentum. This quarter, search delivered double-digit revenue growth, end quote. But then he goes on to say, AI Overviews now has over 2 billion monthly users across more than 200 countries and territories and 40 languages, end quote. Now, if you don't use Google, these AI Overviews gives you the summary that appears at the top of the search pages. It's a game changer that makes people want to keep coming back to Google search, even as many, like me, worried that search may go the way of the dodo. I mean, why do search? I figure when you can just go right to one of the major chatbots, avoiding Google search entirely. They're not. They're going to more than ever. Pichai explains they're not mutually exclusive. It's easy to just stick the AI results in there because, well, he's got the leading global network of AI optimized data centers. In other words, he who spends the most money on AI wins. I am sure we'll hear something similar next week from Meta and Microsoft and Amazon. I wish I could say the same about Apple, but it remains on the sidelines. When you hear about this spending, you should be thinking one thing. Nvidia. You can't be dominant in search unless you buy the latest and greatest chips from Jensen Huang, CEO of Nvidia. The naysayers tell us that spending is a big waste of money. But if you listen to Jensen, he says his best hardware and software stacks can give you 4 times your money's worth. Given what Alphabet said last night, you know what? I think it probably works out to about 4 times. Now, Nvidia is not a tax on the system. It's an expander. It's a force multiplier. That's why it is so important for the U.S. government to allow China to have a version of NVIDIA's AI technology. You know, we tend to assume that China makes everything we want while needing nothing from us, aside from those NVIDIA semiconductors. That's not really true. We're beginning to get cheaper products from elsewhere, by the way. We know from Judy Marks, the CEO of Otis, the elevator company, that China's business is miserable right now. We know from Jim Fitterling, the CEO of Dow Inc., that China's no longer the cheapest place to make plastic. Just pick those two because it happened in the last 24 hours. Really, China's got 2 things going for it. It's got electric cars and first-class military. But what it needs more than ever is NVIDIA's chip stack. That's the only reason they're willing to make a deal with us on trade, even releasing their chokehold on rare earth minerals. NVIDIA. Still, the skepticism is thick and, frankly, somewhat justified. I'm heavily reliant on some of the chatbot sites, not all, but I spend a lot of time on them. I'm chiefly on Grok, the Elon Musk site that spoke about in this otherwise not so hot Tesla conference call last night. I checked the advanced ChatGPT, mostly out of respect for Sarah Fryer, the fabulous CFO of OpenAI. I use Claude from Anthropic because my computer-savvy daughter tells me it's the best one right now. Meta AI is my go-to for pop culture. And I'm on Perplexity probably 25 times a day, if not more, in part because Jensen Huang told me he looks at it regularly, which got me hooked. Last night, in a rare game to be actually human, I went out with my wife and her friend, something I never do, especially during earnings season. It was a huge amount of fun, by the way, definitely kind of playing hooky. And I realized when it was over, I was way behind the 8 ball when the dinner broke up, even as I remembered why people go out to dinner, because it really is kind of fun. So I decided I needed to take a shortcut of AI and began to prompt the sites for information about some earnings. For the first Chipotle, I got a couple of nuggets, but I knew I'd have to wake up early and read through that one. Then I put in IBM, and all the sites had the same thing. Software was a little soft. Nothing else, though. Then I knew I needed ServiceNow, okay? Because it seems to have the most exposure to AI as a software, as a service play, and you got to know what they're saying. I knew the stock had enjoyed a significant move higher after the bell last night, although some people said it couldn't last. So what I did was around 10:30, 11 o'clock, I went to one of the chatbot sites. I will not reveal which one because it's so embarrassing. And I put in the prompt about why did ServiceNow stock go up after the company reported and then down after the conference call? Because that's what I figured would happen. There appeared an astounding story about how the slowdown in enterprise software had finally hit ServiceNow, and the company's high valuation made it very vulnerable. Now, I knew there could be some weakness because the software as a service sector is not as strong as it used to be. They charge by the person, and if AI is replacing humans, that means fewer people. But I started jotting down notes about what caused the real weakness and how management addressed the weakness if they could. I knew I had a good story about the decline and fall of ServiceNow. Until the next day, when I checked some actual news organizations and saw the stock was actually flying high after a much better than expected quarter. The story I read on the AI-generated site was 100% wrong. They know nothing! Now, I don't know why this ridiculously embarrassing incident even occurred, but it's not exactly unusual for these AI platforms to make things up. Here's what I do know. The more new chips you have from Nvidia, the less likely your AI will get things wrong like I saw last night about ServiceNow. I also believe there's so much skepticism in large part because people simply don't trust the answers they get from these platforms. You know what? Rightly so. So my take is that Google is upping its spending because the most accurate chatbot will be the winner, just like how Google Search won to begin with. The bots that are wrong too often will lose. And just like Google Search, if you win the AI race, you can end up with a near monopoly and hundreds of billions of dollars in profits. My conclusion, these companies aren't overspending on AI. They are actually underspending on AI. Underspending. See, this is a winner-take-all, loser-take-none situation. The only reason to spend less is if you don't believe you can win. Bottom line, that's the reason why Nvidia is the largest company in the universe. It's why Apple has to use this moment to make a good site great. And it's why Google's still in the conversation and might even end up winning the battle for AI just like it won the battle for search. Gabe in Michigan. Gabe.
Hey, Jim. Big booyah here from Michigan and club member.
Oh, thank you, Gabe. Thank you very much. Jeff and I were really cooking today on the Honeywell in Dover, weren't we?
Yes. I have a question for you, sir. Given the significant program charges and reduced cash flow in Q2 here, how do you assess its ability to sustain long-term growth, especially in light of the increased defense demand and ongoing development challenges and legacy programs for Lockheed Martin?
Look, I know Jim Takelet. I know he's going to figure this out, but everybody tells me, every single research node told me that you have to buy Northrop Grumman for when it comes to the weapon, the big defense procurement. And I still like AeroVironment, AVAV. I mean, it was AVAV. He broke the story. Nawabi broke the story about why things were so great there. And that stock is up about 90 points since he came on the show, and I'm sticking by it. Now we're going to go to Ali in New York. Ali.
Hi, Jim.
Hi, Ali. What's up?
Hi. Good. First, congrats on 20 years.
Oh, thank you.
I'm up 17% on the stock I bought this spring. It is 70% up this past year, but it's still down 39% from its all-time high, and it's down almost 10% this month. Morgan Stanley issued a positive note on its new CEO, but they've had insider selling recently, and it is enterprise software. I'm wondering if they report a good quarter next month, should I sell or trim my position? The stock is Snowflake.
Okay, Snowflake. Well, Sridhar Ramaswamy came on our show and broke the story of that much better than expected quarter. And I say you just hold on to this. There's going to be ups and downs. Maybe it takes a little of the fluff out of it. But Sridhar is good for it. And I think that could be a great long-term position. I like the stock of Snowflake. Right, the AI race, it could be a winner-spend-all situation. I think the only reason a company wouldn't spend money is because they already think they're going to lose. Well, maybe tell you, Honeywell reported an earnings beat, but the stock fell in response. So are investors getting an opportunity to pick up a high-quality name at a discount, or am I just a complete and utter idiot? I'll tell you what, let's check in with the CEO to find out. Then I was worried about the club stock Danaher, DHR, going into this quarter. But the report really helped us solidify our thesis. I'm going to give you my take on the name. And we're all about covering the stories that you want to hear, even if I think they're too speculative. So tonight I'm checking in with one that I know you're interested in, a quantum computing company called IonQ. You get a read on the state of this burgeoning industry, and I'm going to cover every single one of these from now on. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
All right, help me here. What in the world just happened to the stock of Honeywell? The iconic industrial, it's in the process of breaking itself up. This morning, the company reported what sure looked to me like a good quarter, top and bottom line beat, management raising their full-year sales and earnings forecast. That's what I always like to see. The stock was climbing in pre-market trading, yet it only got hit and finished the session down 6%. And look, the quarter wasn't perfect. There was some margin pressure, especially in the aerospace business, but much of the raised guidance comes down to a weak dollar, maybe some acquisitions. Still, I think it's crazy the stock pulled back this hard when we were getting so close to a three-way breakup that could really unlock a lot of value for you. But don't take it from me. Let's dig in with Vimal Kapoor. He's the chairman and CEO of Honeywell to learn more. Mr. Kapoor, welcome back to Mad Money.
Hi, Jim. Good to be back with you.
Oh, thank you, Vimal. Okay, so Vimal, I got the release. I looked at a quarter of six. And I like to look at things in the cold of day, and I realized, wow, this is really a good quarter. There's so many moving parts, but it's going in the right direction. Stock was looking up, and then it turned down. I have to tell you, I think that the turn down is a false narrative. But I'm going to give you the floor because of the many, many parts. Maybe there were 20. We found maybe 3 wrong and 17 better. Could you help us here?
Yeah, look, Jim, if you see the quarter print, it's very clean. Overall, we had a 9-cent beat to the consensus. Our organic growth was 5%, and 3 out of the 4 segments grew more than 5%, and 1 segment was flat. And it has been a while. Honeywell has printed a performance like this, where we had a secular growth in 3 of our segments at that high rate. And we raised the guide for the rest of the year. We started the year at 1010 to 1050. Now we are at 1045 to 1065. High confidence to deliver that guide. So overall, I would say how the year is progressing, we are very pleased with that. I mean, I won't comment on the market reaction. Sure. But what's also important, Jim, is apart from the financial performance, we are executing the 3-way separation on time. So we also announced today that we're going to spin the advanced materials business, our chemical business, in Q4. So that's going to definitely happen in a couple of months. And then we are on plan for separation of aerospace in 2026. And the third dimension, while we are doing this work, we're also transforming the portfolio. We completed the separation of our personal protective equipment business. We made 2 more acquisition announcements. So there's a lot going on, and I really feel excited how we're executing to what we say. And there's a lot of promising time ahead for Honeywell.
Well, I also think that there were two divisions that you felt weren't doing things right, and you said, listen, we're going to review those too, which means that if you don't think they can be fixed, I think that theirs are going to go too. But they counted against you, even though you said that it could be transitory. I think that people were just trying to shadow box with you.
Yeah, I mean, if you look at the 2 businesses, Jim, which you mentioned, we chose, they are very good businesses. Our workflow automation business, warehouse automation business, which is popularly known, very well-run business. We also have a business in scanning and mobility productivity solutions. Both these businesses fit less in the future I'm imagining for Honeywell, because we also want to have a Honeywell which is simple to understand. Our shareholders can clearly understand the value proposition, the verticals we play, our business model. So it's not that these are the bad businesses. We are really looking at the better fit for these businesses with the next owner. And it helps us to simplify Honeywell into 3 end markets. So when we complete the spin of aerospace and chemicals business, the remaining Honeywell will be just focused on pure play automation. focused on 3 end markets, process, industrial, and buildings. And these are compelling markets. There's a $500 billion TAM, a lot of growth opportunity available. So that's what really excites me. And that's the reason, Jim, we are proactively investing in R&D. One of the reason our margins are flattish year on year, we're ramping up R&D, $100 million we talked about in this quarter. But for the whole year, the impact is about 40 basis points on the margin. But that's a good thing. We are investing for the future. We are building the portfolio. We're investing in the right new products. So we're keeping the company ready for the very compelling future ahead. So that's what excites me.
Meanwhile, that Carrier acquisition was fantastic. I mean, to me, it's cut and dried how great that was. People didn't want to focus on that.
Absolutely. Jim, that acquisition has gone extremely well. You can see the margin rates of building automation, how the building automation business is performing. 3 quarters in a row, 8% growth. Part of that is this acquisition is playing. The synergies are really working. Margin is expanding. So the acquisitions we made, they're all pivoting us towards higher growth end markets. That's a really focus we have been doing. We made acquisition of Access Solution. We made acquisition in the LNG area. All of that is really pivoting Honeywell to higher growth end markets. And we are well positioned with the work we are doing organically and the work we are doing inorganically. So we'll continue to stay focused on what we can control, and we'll let market decide, how they should value us.
Now, look, I know you've told me don't get ahead of yourself, but we've been doing a lot on quantum computing. And one of our actual guests tonight said that they feel like they're in the league with Quantinuum. I mean, they brought it up. I didn't. He said, we're in the league with Quantinuum. And here I think that you don't even necessarily want to get anyone too excited about it because you're a hard-nosed business person. It's not the kind of thing you do. But when I hear another guest say that they think they're in league with you, I need to ask you, what does it mean to be in league with Quantinuum?
Look, Quantinuum is another exciting part of Honeywell. And Jim, we talked about it before. We are committed to do an IP of Quantinuum. I would say that next 18 to 24 months' time, probably more towards later part of 2027. The business is progressing well. We are making the right commercial progress. We got a big deal from Qatar, for example, during President Trump's visit in Qatar a couple of weeks back. We are doing a fundraise as we speak so that we could make sure that the company has enough cash to work towards before the IPO. But what I can say to you is we are executing to all our milestone. And I feel quite confident that Quantinuum should be able to get into IPO in next 18 to 24 months' time.
Oh, that's great. Also, I want to tell people that Dave Cote is my friend. He was my next door neighbor. You are continuing with the tradition of Dave, which is get this portfolio to where it could be. I mean, the PPE he had, that was a great idea at the time. You did what I think was right, was get rid of it. But this is the shuffling to make it better and better that's going on. I think it's confusing people, Vimal, and they shouldn't be confused.
No, Jim, we will do, I think we have done so much of work in our portfolio, so clearly we need to do a better job to tell our story. But as we complete these separations, part of it is going to be that we're going to tell our story across each of the 3 businesses. So we're going to have an investor day for our chemicals business later part of this year. We should be on the road sometime in Q2 next year as we are nearing the spins of aerospace and automation business. So yeah, I think the big part is we have made our portfolio and story very compelling, but we probably need to do a better job to get our story across to the market.
Well, no, I want our club members to buy it.
And we are
I want us to buy it before you get the story too far across, because it is so clear and evident to me what's happening here. I think you're doing a sensational job. This is a very big spin, and it's really going to work. I want to thank Vimal Kapur. He's the chairman and CEO of Honeywell International. Read the deck. It's so transparent. You will reach the conclusion that I did. Trust me. Mad Money's back after the break.
Coming up, is the embattled life sciences name finally showing signs of life? Cramer's checking up on diagnostics company Danaher to break down the numbers. Next.
Coming into this week, I was really worried about Danaher, the life science and diagnostic powerhouse, beyond for the Travel Trust. You can follow, of course, by joining the CNBC Investing Club. See, for many years, Danaher was arguably the best-run conglomerate on earth. And the stock has been a phenomenal long-term winner, up over 1,000% over the past 20 years. But ever since we got through the pandemic, the stock has struggled to get back on track. Now, we bought this one in early 2022. We happened to own it for a couple times previous in order to get a chance to buy Danaher on weakness, because I expected the business to stabilize and the stock to make a comeback like that. But for one reason after another, Danaher never really found its footing. First, it was China's slower recovery from the pandemic. Then customers overordered in response to the supply chain crisis, leaving them with excess inventory, meaning no need to buy new stuff from these guys. Then it was that tepid IPO market, because fewer biotech IPOs translates into fewer new drug companies with money to spend on Danaher's equipment. Oh, then it was President Trump's tariff extravaganza, along with the spending cuts to the National Institutes of Health. Again, less money for the life sciences equipment. As a result, this has been a tough stock to own. Danaher always seems to be on the verge of getting better, and historically it's been one of the best-run companies on earth. But in the last few years, they keep dropping the ball. And remember, I blame them because I don't really care about their excuses. I want wins. Now, making things worse, Abbott Labs and other charitable trust holdings saw a major pullback last week. And that was in part because of issues with the Chinese business. Remember, Danaher's big China exposure. So we decided to sell a bit of Danaher for the charitable trust just in case something went wrong with the quarter. That's how worried we were. And I got to tell you, when Danaher reported on Tuesday morning, it almost gave me a heart attack because the stock immediately got clobbered. The company actually delivered a pretty good set of numbers, a healthy revenue beat, steady organic growth, and better than expected margins, all leading up to a 16-cent earnings beat of $1.64 basis. I like that. Now, the last time Danaher reported strong results in April, management paired that with very cautious guidance, which held the stock back. This time, though, management raised their full-year earnings forecast and also gave healthy guidance for the current quarter. Now, at first, I breathed a sigh of relief when I saw those numbers. But then I checked the stock, and somehow it was down. In fact, at one point, it was down nearly 7% in pre-market trading. Well, guess what I wanted to do? This earnings season has been a real roller coaster for the Travel Trust, and that plunge in Danaher almost drove me insane. Oh, you might argue I was already insane, but I mean, new levels of insanity. I started trying to figure out what the heck Danaher did wrong this time. Snake bit. Were investors objecting to the fact that Danaher only raised its full-year earnings forecast, not taking up the revenue numbers, even though they reported a revenue beat? Was that it? Was there a China issue like we saw from Abbott Labs? Maybe investors were disappointed that Danaher announced its CFO, Matthew McGrew, would be retiring next year. This is how I was grasping at straws. I didn't know what the issue was. I just couldn't believe it was happening again, even after the company mustered some fairly solid numbers and good guidance. But thankfully, this story got a happy ending this time around. The stock rebounded from its lows on Tuesday morning and was almost back to even by the time the market opened. Then Danaher rallied, although it was choppy, and it finished the session up 1%. Hey, not great, but certainly not the end of the world. Things got better yesterday when, upon further review, buyers stepped in and the stock shot up nearly $8 or 4.2%. Then it tacked on another 2.5% today. Only this quarter was a positive catalyst for Danaher stock, as it always should have been. Because when you really looked into the numbers like we did with the Investing Club for subscribers, there was so much to like here. Of course, that doesn't mean everything's suddenly perfect for Danaher. There's some hair on this one, like in your soup. Starting with the thing I've been most worried about, and that's China. Sales were down mid-single digits in the People's Republic versus modest growth in North America and high single-digit growth in Western Europe. On the conference call this week, Reiner Blair tried to stress that only parts of China are bad, touting strength in the company's biotechnology and life sciences businesses, but said that those were more than offset by the decline in Danaher's diagnostics business due to volume-based procurement and reimbursement changes that were implemented by the Chinese authorities late last year. It's not just Danaher, believe me, everybody got hit by this. This volume-based procurement issue is a result of China's national strategy to curb healthcare costs. And it's the same problem that plagued Abbott when they reported last week. I was upset about that, too. But putting aside China, I think there was far more good news than bad news this quarter. For example, while all three of Danaher's core segments reported better than expected results, their highest margin biotechnology segment led the way. That had 8% sales growth. That's 150 basis points of operating margin expansion and operating income of more than 12%. Wow, that's very good. The core of Danaher's biotechnology segment is its bioprocessing division. Now, it is about a $6 billion business, but one that's struggled in recent quarters. Finally, though, bioprocessing looks to be on the mend. A few months ago, management started talking about positive order trends for that business, and now Danaher says these trends continued throughout the second quarter. That's great. The book-to-bill ratio for bioprocessing orders remains at around 1, meaning the company's fulfilling orders about as quickly as they get them. In particular, Danaher is seeing success with monoclonal antibodies, which represented over 75% of the bioprocessing unit sales. That's good, too. Here's how the CEO put it, quote, overall order activity in the first half and second quarter are fully supportive of a high single-digit core growth in the second half, end quote. And he thinks bioprocessing can maintain high single growth long term. Pretty good. So after investors had time to digest Danaher's quarter on Tuesday, they ultimately decided that the good did outweigh the bad, and the stock broke out the upside next day. Now, remember, we saw the same problem, the same issue in we saw it in Domino's on Monday and Tuesday. Sadly, during the height of earnings season investors, they're so quick to judge. Many saw the stock down in pre-market trading on Tuesday and simply figured that there must have been something really bad about the Danaher quarter, when it simply wasn't the case. I'm betting that that's going to be the same thing for Honeywell, for the same thing for Dover. See, it was only after investors looked more closely that the stock finally got its due and may at last be poised and ready to return to the wondrous days of the old Danaher. Here's the bottom line. It's been very tough to be a bull on Danaher for the past couple of years, and the company's still not perfect. But I think we've finally reached the tipping point here now that the core bioprocessing business is on the rebound. That's why we're sticking around for the Charitable Trust and why you have my blessing to pick up some of the stock right here. Let's go to Todd in California. Todd.
Hey, how you doing? Hey, with all the managed healthcare companies just getting shellacked, is now a good time to maybe take a nibble at Cigna?
I want you to wait until United Health makes a clear vision of what's really going wrong. So United Health is going to report, and that's going to be coming up. And then once they report, we then look at the downside for the rest of the group, and we make decisions. Now, that's only 5 days away. So let's make sure we wait, bat on shoulder, and then we'll make our move. All right, look, guys, it's been real tough to be a bull in Danaher lately, but I think the business is finally turning around. That's why I'm sticking with it, and you should do some buying. Now, much more Mad Money at this year's Nvidia GTC conference. Jensen held Quantum Computing Day. So we need to understand more about this industry. I'm checking in with one of the players in the space called IonQ. Then Leadership Matters in Bull Market. I am sharing which groups are leading us higher and why it matters. And of course, all your calls, rapid fire, in tonight's edition of the Lightning Round. So stay with Cramer. I've always made it my mission to shine a spotlight, not just on the companies that Wall Street wants to hear about, but the ones that you want to hear about. Which brings me to IonQ. It's one of the quantum computing plays that has dominated this market for the past year. You ask a lot of questions about it, and especially in the past few months, it's really gone. Well, I'd say the thing's up 476% over the past 12 months. And after pulling back hard earlier this year, it's now up 145% from its March lows. I know you want that. I don't blame you. I would too. Now, I used to resist recommending highly speculative stocks like IonQ with no earnings, not much in the way of revenue. But in this market, anything with a good story has the potential to become a huge winner, and I work for you. So let's check in with Niccolo De Masi. He's the CEO of IonQ to get a better understanding of why so many people are excited about this. Mr. De Masi, welcome to Mad Money.
Honor and pleasure to be here, sir. Big fan.
Well, thank you. Well, I've got to tell you, I first came across your company when Peter Chapman, who's your executive chairman, he spoke at GTC. And I think it had a real impact on Jensen Huang, who's the CEO of Nvidia. But candidly, I asked him about it, and he said, Jim, you really got to study, and then you still may not understand it. We have a very candid relationship. So I know we can't ask everyone to study, but I want to give you the microphone. Just tell us why this technology is so exciting and where you fit in it.
Yeah. Well, look, IonQ is the biggest player in the business of quantum, right? We are the 800-pound gorilla of both quantum computing and quantum networking. So we're, in fact, a fully fledged quantum internet company, right? So we're building the most powerful and most affordable quantum computers. We're also building the networks, nodes, repeaters to be able to communicate safely, not just safely in a classical world, but safely in a quantum world where quantum computers are going to crack RSA in the coming years. We are racing China, we believe almost single-handedly for the Western world, if you will, to be the RSA cracker. And of course, when that happens, everybody's going to need our quantum networking equipment to make sure that the world as we know it and civilization as we know it goes on. You mentioned Jensen Huang and GTC. We've actually been on 2 GTCs this year, and they were both very impactful, right? So Peter did the one in March, and then we did one in Paris, and we've demonstrated quantum advantage now twice. The first time was with Ansys and Synopsys back in March. Sure. And then more recently, it was in Paris where we announced the 20x speed up in partnership with Nvidia and Amazon Web Services. And no one can really say that a 20x speed up is not, real quantum advantage. The era of what's called quantum supremacy is just around the corner. It's coming in quarters and very low single-digit years. And that's getting people obviously pretty excited about the fact that we'll be able to do things to help every area of applied science. Well, right? From drug discovery to logistics.
Well, let's take pharmaceuticals, okay? Now, pharmaceuticals right now, we have a lot of pharmaceuticals that are meant to keep you alive for 5 months. There's a tremendous, maybe hundreds of billions of dollars spent to make it so that you can live for 4 or 5 months. Are you guys thinking about instead of maintenance, would you be doing cure? Or is there diseases that are really hard that people spend fortunes on and no luck? You would address them. Where would you be in that vertical?
Yeah. So all the bits of computational analysis in this world, from engineering to drug discovery, we announced a protein folding partnership and success, just a month or so ago. And so our machines are now on the verge of simulating molecules, that are probably 30, 35, atoms, molecules long. And so we're doing things in the next year that classical computers will not be able to do to predict and also look at molecules through a quantum lens, right? And so I think you're going to see a plethora of both chronic as well as, critical, if you will, drug discovery breakthroughs. And it's just going to keep going from there. As our machines get more powerful, we'll be able to model ever bigger molecules. Okay, so right? Same with material science.
But Jensen told me that in the end, with companies like you, he would still have to play a role. That he now supports quantum, but he said, look, Jim, NVIDIA's going to be involved if it's quantum. They need us. Why is that?
Yeah, I think we're the biggest reason, honestly, in the last 6 months why Jensen has changed his perspective on this sector. We've demonstrated, 2 partnerships with him where we've shown quantum advantage, and we've shown that, yes, we're going to grow with him in the coming years. Kind of like when GPUs, were an earlier thing and we were growing with CPUs. There will be a day where quantum processing units, particularly ours, where we are an order of magnitude, if not 2 orders of magnitude cheaper than any other path to what's called a fully fault-tolerant machine in the coming years. Okay, and so we expect to take down more pieces of the total compute space as our energy needs are lower than classical and our machines are cheaper than everybody else's in the space.
Okay, so how did the Defense Department discover you? How did the Air Force discover you?
Well, we're a 30-year-old business, right? So we were founded, really on work that was done in the mid-90s. Our founder is the father of quantum computing hardware. We're the first to demonstrate it in the lab. We're the first to commercialize, right? And these advantages, Jim, last a really long time. Reminds me of companies like, ASML that have been plugging away at, effectively ultraviolet flashing of chips for 30, 40 years, and they continue to lead the sector. I've always believed as a physicist originally, and I, of course, was the SPAC sponsor that took IonQ public. So I've raised maybe 85% of the total money invested in IonQ, either the CEO of IQ or CEO of the SPAC before. And, the reality is I've looked at the space many times. The leadership that IonQ has in its technology, because we started first and because we picked the best path that runs with the least energy, runs at room temperature, gets to commercial advantage first, is something we're just building on, right? And we're building on that both organically and inorganically, as I've shown the last 3 or 4 or 5 months.
Now, but we are talking about waiting to 2030 before we think about making money. Now, that requires a certain kind of mindset investor, right? I mean, you don't want someone who was thinking this thing's going to have its big breakthrough in 2026.
Well, we're having big breakthroughs actually
every day,
almost every month if you follow the press, right? So it's bigger breakthroughs. And one of the things, Jim, that gets people excited, I think, about IonQ in particular is we're moving the size of our machines forward so quickly that we're doubling the compute space, sometimes every week, sometimes every month, right? And so generations of our machines are not a factor of two bigger like Moore's Law. They could be hundreds of millions of times more powerful. They could be billions of times, maybe even trillions of times more powerful because the scaling gets so vertical in the next few years that classical computers can't write out the size of the number if you look at 2 to the power of the large little qubits that we'll be producing.
All right. Well, look.
So totally new paradigm.
I have to let it go there. I am fascinated by everything you say. I know I have to do some sort of special or something about this because our viewers want it and they are owed it. And I just learned, even in this short snippet, I learned why Jensen changed his mind and why he started talking about how it's sooner rather than later because of things that you did. So I want to thank you, Niccolo de Masi, CEO of IonQ. It was great to have you on. I hope you come back.
Look forward to coming back. Maybe we can co-host an hour next time.
Well, why not? We should do that. I've always been looking for someone to fill in for me. Anyway, Mad Money's back after the break. Thank you. Good to talk to you.
Coming up, Cramer takes your calls. And the sky's the limit. It's a fast-fire lightning round. Next.
It is time. It's time for the lightning round. Also, somebody stop questions. My steppers, the website, the your plan is out. And then the lightning round is over. Are you ready? Ski dash. Lightning round comes to Daniel, New Jersey. Daniel.
Hi, Jim. The AI revolution is here, and the money is pouring in. This stock's lunch has already been eaten by traditional Gen AI, putting chip companies like Nvidia and AMD, as well as big tech like Meta, Microsoft, OpenAI, Apple, Amazon, Google, and even Tesla in perfect position to benefit tremendously by utilizing the treasure trove of clean, legal photos and videos from Getty Images and Shutterstock to better train their LLM AI models to produce real-time images.
Which one? You want them both? Look, one of them's making money, Shutterstock. One of them's losing money, Getty. I think Shutterstock's better, but doesn't really have the growth that I'd like to see. But you can pick up the yield maybe to get some growth. But it's really been, frankly, it's been a labor of not like. And I don't like labors of not like. Let's go to Richard in New York. Richard!
Sir, Jimmy Chill. Love what you do. Watch you all the time. And I know I need to be a club member.
Oh, absolutely.
Today, I'm crazy about my best of the breed collection. However, I'm starting to grow a position in a brand, in a stock. I'm kind of concerned, not sure if it's worth going long or going short. The stock is ET.
No, ET got its act together a long time ago. It's a really, really good stock. I'm going to give him a 2 for it because I really like this fella. Yeah, I think One Oak is real good too. All right, so you get the ET and the One Oak, both good to go. Let's take one more call. Let's go to Karen in Florida. Karen.
Hi, Jim. I'm a founding member of the investment club, and I want to thank you so much for helping me become a better investor.
Thank you. Yeah, that's the goal. That's the goal.
Thank you. So my question is, with AI infrastructure spend increasing, Nvidia invested in this company, Goldman Sachs initiating coverage, and Jeff Bezos recently backing one of its subsidiaries, Toloka, is Nebius Group, ticker NBIS, a buy?
Look, I totally get Nebius Group, but I am through and through a core wave person. And because I'm a core wave person, can't own both. But we kicked the tires Nebius and we went all in core wave, and I'm not going to change my view. I got to take one more call. I'm going to go to Stanley in California. Stanley.
Hi, Jim Cramer. This is
Hi, Stanley.
Formerly from Philadelphia, now living in California.
Lucky
Thanks
guy.
for your insight and advice over many years. I've watched Mad Money.
Thank you. Thank you.
The stock price of this financial services company has increased about 8% in the past month and 75% in the past year. What are your thoughts about StoneX Group? Ticker.
I don't know, StoneX Group. I'm mortified and embarrassed and feel like I have no clothes on. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab.
There's nothing like the banks and brokers to provide leadership in a bull market. Most people don't realize the importance of leadership in the stock market in general, but it matters. And some groups make much better leaders than others. When the ordinary non-tech financials are winning, you know that the rally's on firm footing. Buy! We often hear about narrow markets, ones that are led by the Magnificent Seven or the speculative stocks, the nuclears, the quantums, the meme stocks, even the semiconductors, enterprise software names. Whenever those groups are leading the charge, they're always greeted with suspicion. We're told they aren't any good for anything but themselves. They have no gravitas, no broad pin action. So they're criticized endlessly. But a rally underpinned by the banks, nobody criticizes those. That's solid granite. Think about what this kind of rally really means. When the banks are in good shape, the whole economy's in good shape. Let me take them one by one so you know what the hell I'm talking about. First, when you see BlackRock powering higher, that means money in, as there are a lot of new contributions go to BlackRock. Call it oxygen. You can't have a sustainable rally without oxygen to feed the fire. BlackRock's got over $12 trillion under management. Can't quibble with that, can you? Second, when the stocks of Goldman Sachs and Morgan Stanley go higher, that means more IPOs, more takeovers are coming. This morning, we got confirmation that Union Pacific and Norfolk Southern are in merger talks. I mean, this is the biggest test we've ever seen of antitrust regime, at least in my life, okay? We have so few railroads in this country, and we want them to compete with each other. All aboard! We always want them to compete with each other. Under President Biden, or honestly any previous president, I think the advisory firms would say, don't even bother doing this deal. But under Trump's regulators, it's an open question. I think the advisors want to test the waters. If they get the go-ahead, that means big fees and a giant green light to any company that wants to merge with a competitor. On top of that, we got word that Figma is coming public, and, we need IPOs. This design software IPO is the kind of deal that will really turn heads, showing people that the window is open. Many companies that pretended they didn't want to come public when the IPO market was ugly, they're going to show up now, hat in hand, if the Figma deal works at this. Great product. Big rival to Adobe. Third, a rally with JP Morgan at the vanguard means we're looking at a wave of commerce that will spur strong business formation and expansion. If JP Morgan is the leader, well, many others will follow. Ooh, I like that. Now, how about this? Wells Fargo. Now, here's a company that actually guided lower when it reported. Charlie Sharp, the CEO, talked about the need to invest in the company's business after 7 years of pretty much being on hold because of regulatory straitjacket. Normally, in this market, a company would be penalized for spending money on anything but a buyback or dividend boost. But Wells Fargo stock is now up from when it reported. A tacit admission that when things are good and getting better, it's worth investing heavily in your own business. And that's exactly what Wells is doing. We own this one for the Charitable Trust. Stocks rebound from last week's lows. Total vindication. Finally, the regional banks. Oh, these are the brick and mortars of any rally. This morning, I saw Ohio's Key Bank got a downgrade after a nice run, and its stock barely got dinged. What does that tell you? First Horizon from Tennessee closed at a new 52-week high yesterday. I like the action in Huntington Bank shares. It feels like a return to the old days when this was a market leader every time the spotlight turned to the regionals. Now, these aren't flashy. When Bank of America announced a $40 billion buyback the other day and nobody even notices, I regard that as a terrific sign. We want boring. We want no flash. We want gray flannel suits. And that's just what we're getting to fuel this rally. So yawn away, but be sure to do some buying. I like to say there's always bull market somewhere. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you next time.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.